Hey, hey, happy Friday, everybody. Welcome to another episode of Freight B Moving All Things Logistics with me, Jewel Williams, your host. And today I've got a great treat. We're going to be talking about income statements. We're going to be looking at some companies, 3PLs to be exact, and their income statements to help us get some insight as to what's going on in this economy. So, first off, we know that inflation is out of control. I'm sure many of you, like myself, are paying more at the grocery store. We also know that the Federal Reserve has increased interest rates. This makes things more challenging on credit card debt, on borrowing money to manage your business or even grow your business. We also know that freight is not going anywhere. We have to continue to eat. So I was curious to see what does the income statement tell us about other transportation and logistics providers. So I decided to take a look at some of the top third-party logistics providers to get an idea of what they have been showing as a trend with revenue, sales, cost of goods sold, profit margins, and most importantly, I think we can get some information from the interest cost. So, the companies I'm going to be looking at today are C.H. Robinson, Expeditors International, J.B. Hunt, Landstar, and Uber Technologies. And what I hoped you guys will gain, as well as myself, is some insights into what these transportation giants are experiencing and if they're experiencing these types of financial either hardships or pluses in their financial statements. This can also be a telltale sign of how owner operators, freight brokers on a smaller scale are also experiencing income ebbs and flows. So, first, let's get into some definitions. Let me share my screen over here. And the first one we want to look at is cost of goods sold. So, what is cost of goods sold? According to Google, the cost of goods sold is the sum of all direct costs associated with making a product. It appears on an income statement and typically includes money spent on raw materials and labor. It does not include costs associated with marketing, sales, and distribution. So the next item that we're going to be looking at on the income statement is the gross profit margin. And the definition here for the gross profit margin says gross margin is the amount of money a company has left after subtracting all direct cost of producing or purchasing the goods or services that it sells. And then the third item that we're going to be looking at is the interest expense. And according to Investopedia, it says an interest expense is the cost incurred by an entity for borrowed funds. Interest expense is a non-operating expense shown on the income statement. So what we can attain here is information that helps us understand the market better, businesses better. And you out there who are smaller business owners who are interested on looking at how to benchmark yourself against the big guys, here's an opportunity to do so. So first off, we're going to take a look at C.H. Robinson. And for those of you who are listening, you can also catch this replay on YouTube where you can see the charts and information that I am displaying on the screen. I also want to pause and ask you to like, subscribe, and share. If you are getting value from this information, follow my channel. I'm going to be having more videos like this coming up so I can help all of you gain insight into the world of business to help you grow your business and learn from there. Also, another announcement I want to make, I will be conducting a masterclass for entrepreneurs. I will have the announcement coming out next week, so be on the lookout for that. I will have a limited amount of space. It will be a free 30-minute webinar to just help you as a business owner get a little bit more tools in your pocket or in your toolbox to help you grow your business. So if you like, subscribe, share, comment below, I would love to hear your feedback. All right, let's get into this first statement. I'm going to share my screen here. And what we're looking at is let me move this over here. So what we're looking at is an Excel spreadsheet. So what I've done is I have pulled data from the website to get the information about the income statements for C.H. Robinson, okay? And so we're looking at 5 years on the C.H. Robinson income statement, going back from 2018 and looking forward to 2022. Now, what we see here is the companies had growth in their sales from 2018 through 2022. And we show a 6.9% sales growth according to their information. Now, also, there's been a growth in their cost of goods sold. This may be the reason why C.H. Robinson had to let go of staffing due to things such as this. So if we look at this in the highlighted area up top, we can see that in 2018, cost of goods sold was 62% of revenue. It dropped in 2019 to 57%. It climbed up a little bit in 2020 to 61%. But then we see two big leaps in 2021 and 2022. In 2022, cost of goods sold was 92% of revenue. 92% of revenue. That's huge. That's a 30% increase in that 5-year span. That's huge. Now, if we look down here, although we don't have any profit details, I'm gonna freeze this. Let me see if I can freeze this view real quick. I know I should have done this earlier. I cannot find it off quickly. Anyway, let me keep going. So I couldn't freeze. I wanted to freeze that so you guys didn't get lost in what we're looking at. But what I'm looking at here on this Excel spreadsheet is their 2022 gross profit was 7.57%. So that's not a lot of profit there. But what's also interesting to see is the interest expense growth percentage. Now in I think this is 2019. So starting in 2019 is when we see some data. They had an interest expense growth of 50.01%. Then they had a drop, and that's due to the interest rates. You remember in 2020, we had the COVID-19, so interest rates really went down. So their interest expense was a negative 5.83%. Of course, that was great for the company. However, they got hit very hard in 2021 with an interest expense of 33.11%. That is huge, considering they came out of 1 year at a negative 5.83%. Now, it did dip a little bit to 28.89% in 2022. But what we can see from this data right here is an explanation as to why C.H. Robinson, a very big 3PL company, and specifically I would consider them a business gauge for the freight brokerage industry, freight forwarding industry because of their size and the amount of business that they do, and specifically in the freight brokerage and freight forwarding sectors. So what we can see here is that the company suffered some serious hits, and that definitely explains why the company went down the way they did and had to lay off people. So the next we want to look at here is Expeditors, and I'm going to pull them up on my screen. Let's get this centered. And what we see here on Expeditors is a similar story. Their sales and revenue is not as high as C.H. Robinson as they showed in 2021. Now, they did not have data for 2022 as of me pulling this data. Now, what we see is a very consistency in their cost of goods sold. They average 86% from 2017 to 2021. That's phenomenal. To me, that says that company understands their cost and they are keeping that in control. They understand where their business model is. They understand the strategy. They've been in this quite a while. So they've managed to keep that at an even 86%. I had to check the math formula several times because I couldn't believe they managed to stay such on that even line. Now, their gross profit margin shows 14.23%, definitely a lot higher than what we see with C.H. Robinson. There was no data for interest expense growth. Either one, the company does not borrow, which is significantly huge. Good for them. That's what I say for that. Good for them. So what we see here from looking at this company, Expeditors is controlling their financials. They're staying close to their plan. They're not allowing too many things to get them off track. And that also may explain why I've not heard any news of them laying off anybody. And we can see why the company is able to keep costs and revenue in control. So the next company we're going to look at is J.B. Hunt. And pull them up here on the screen. Center that for you. And J.B. Hunt also didn't show a lot of revenue between 2018 and 2022. Their revenue sales growth went from, in 2019, they had a sales growth of 6.39%, and they jumped to 21.74%. Now in 2021, of course, it was higher. We all know that a lot of that was due to the COVID and things getting back online, and it settled down at 21.74%. Now they managed to keep their cost of goods sold percentage fairly even as well at 89% cost of goods sold. Their profit margin shows 11.15%. Very good. Now we also see their interest expense growth. Now they had a huge interest expense in 2019 at 35.27%, and then a significant drop, a negative 12.99% in 2020, and then another negative 2.79% in 2021. And it looks like the company was able to obviously get rid of some debt as opposed to incurring more debt, because we see that their interest expense only jumped to 8.49%. So kudos for J.B. Hunt. Well done, as they were able to keep their interest expense below the 10% mark compared to C.H. Robinson and the other companies. That's doing a great job. Now, what I find interesting, though, J.B. Hunt has power units, tractors, and trailers, and C.H. Robinson does not. So I question why C.H. Robinson has so much debt, so much interest in their expenses, growth. Why is that so high compared to a company such as J.B. Hunt, who we know has equipment? Most of C.H. Robinson is being a 3PL that they don't have any equipment. They buy space from other equipment companies. So that is a question, definitely to look at. Where's the interest? Where's the money going? And that might be, again, why they, C.H. Robinson, let go of so many people. And now we're going to move over here to Landstar. For those of you who are not familiar with Landstar, they do a lot of work with owner-operators. So if you are an owner-operator out there, Landstar is definitely a company you probably deal with in helping you get the loads that you need and teaming up with them. Now, if we take a look at Landstar, we see Landstar had some sales growth. They went in 2019, they were at a 15.35% sales growth margin. They dropped in 2020, of course, COVID. So they dropped down to a negative 14.32%. However, in 2021 and 2022, they excelled far beyond 2019 and 2020 numbers, as they show a 56.70% sales growth in 2021, added another 30% on top of that to 82.62%. Well done. Now, their cost of goods sold also went up with that. We see they stayed within that 65% to 68% range between 2018 and 2021. However, it creeped up a little bit in 2022 to 72%. Their profit margin came in at 27.79%. So in line with their sales growth. So it looks like they were able to keep a big part of their money. However, we have a caveat down here. Their interest expense growth is up to 16.98%. Now, prior to that, the company had been working between 2019 and 2020. They had a negative interest expense growth. In 2019, it was a negative 13.73%. It went down some more to a negative 18.07%. And then we see in 2021, it begins to creep up. And now they're above that 10% mark in 2022, coming in at 16.98%. So good that they were able to control their cost of goods sold. Excellent, because they stayed within the range points, I would say between 8 percentage points. However, because of the interest that of the cost of borrowing money has gone up, it's eating into their profits. So what we can see from these numbers is as interest rates go up, profits, even though they look good here, they're being nibbled away due to the interest rates. Okay, and that's something that is impacting and influencing how these companies are operating today. Because with this information, this is what an analysis of their income statement in this format, which is called a vertical analysis. Managers utilize this information to make decisions on how they're going to do operations and other projects that they have with the company. So from this, I hope that you guys are gaining some insight into understanding how these bigger companies are being impacted by inflation rates and how they are also having challenges with keeping money in their pocket. So last but definitely not least, we're going to take a look at Uber Technologies. Now, Uber Technologies, these particular numbers also include the other business sectors of Uber. I did not carve out just the freight. However, we can get a pretty good idea because Uber's technically all about, no pun intended, is technically a transportation company. Whether they're moving freight or whether they're moving people, they are a transportation company. Now, one story I would like to highlight that would definitely add to this is Uber purchased Trans-Pacific. They finally sealed that deal in 2021. They started the talks of that deal, I think, around 2019, 2020. And in 2021, they finally purchased Trans-Place. Trans-Place, I talked about this in another video. I'll put the link up there so you guys can watch this, watch that video. And in the video, I highlight that Uber purchased Trans-Place. Trans-Place is a platform shippers use to upload freight and containers and shipments that they want to move from point A to point B. Uber acts as a digital broker. Carriers sign up with Uber Freight or Uber Technologies, and then they can go on the Uber platform and they can bid directly with the shippers, eliminating freight brokers. Freight brokers, technology is squeezing in on your territory. Be mindful of that. Do not think that this is a trend that's going to go away. It is not. All right, that was my spiel for that. Once again, I just want to add, comment down below if you find that this information is helping you out. If you find that you like what I'm talking about, subscribe to the channel, share the content, and I definitely would love to hear your feedback on how this information is helping you or not helping you, good or bad. All right, let's get back into this final look at this income statement with Uber. So what we see here on the Uber, we've got 2018 to 2022. We have a growth of 15.35% in 2019 in sales. Now it dipped in 2020. They went down by negative 14.32%. And I'm going to take a pretty good guess that not only was that a part of the 2020 pandemic, also they were in talks about Trans-Place. So, and as you can see, the gamble that they took on Trans-Place paid off in 2021 with a gross sales growth of 56.70%. And then they added another 30-something% to 82.62%. Uber definitely won on that one. Their profit margin, 27.79%. And I believe they had the highest profit margin of all of these 3PLs that I did today. So what we can see here is Uber being the go-between, the middle person, has leveraged their technology to make the biggest profit. Technology is taking over. As companies see the value in utilizing technology like Uber is doing and seeing the gross profit margin value, if this trend continues with Uber, companies will jump on board and they are going to want to do the same thing. Definitely going to want to do the same thing. Now, something interesting though, as we have talked about, interest expense is up. Now, in 2019, they had a negative 13.73% and a negative 0.18.7% in 2020. Now, it edged up a little bit to 5.46%. But as you see here in 2022, when the Fed began to raise interest rates, you see what the reaction was and the ripple effect and the impact that it has on companies who are borrowing money like Uber. So at 16.98%. So with that, we can go down here and we can see net income growth for Uber was a negative 1,741% and 70.73%. Ooh, let me say that again. Negative 1,741.73% net margin was a negative 28.66%. So we can see how the ripple effect of money, because if you look at the other years, they did well. But when interest rates start to creep up, profit goes down, the ability to buy and make other purchases goes down. There is a ripple effect in the business model. And so with all of this information that I provided with you today, I'm hoping that you can see how these larger companies are impacted by the inflation that is happening, by the increase in the interest rate by the Fed, and that also trickles into the grocery stores of the consumer. Because we, at the end of the day, are the ones that are paying for all of this. Because if we don't order food, and if we don't need clothes, and if we don't buy hair products, and if we don't buy the equipment that I have here today, they don't have a job. They don't have a purpose of being. So the consumer is the one that winds up paying and flipping the bill for the Ubers, the Expeditors, the Landstars, the JB Hunts, and the CH Robinsons. So I hope this information was helpful for you. I hope you got a lot of value out of it. And I will be doing more of these analyzings as this is a part of my new study as I earn my MBA and learn how to do business analyst. And I want to share that information with you so that you guys can grow your business and become more successful. Once again, I'm going to mention keep a lookout because I will be having a masterclass webinar. It'll be for 30 minutes. I will announce the dates next week, and I hope you guys will sign up for it so that we can do some one-on-one and have your questions. You can ask me questions, and I'll provide you with answers. I'm going to have a number of spots, so keep your eyes open for the announcements. All right. Have a great weekend. Don't forget, like, subscribe, share, and be safe. Peace.